building an indie business in the center of venture capital. But today, we're in a different location. Instead of the indie business studio, we are in downtown San Jose in some hotel. I'm here with Brendan Weinstein. Today, we will be talking about investing and the new rules that just were created to make investing more accessible. So we're going to talk about the new rules, what were the requirements before, and a few other things. So let's get into it. All right.
Well, I think he forgot to mention, first of all, hey guys, but I think the main difference is not the location. The main difference is Alex and I are actually together for this podcast. This is the first time we've ever, been together in person at all, but certainly the first time we've been able to record a podcast together in person. So.
Yeah, but dude, I don't really consider you a guest. You're just someone who has information, and I put you on the podcast to give me that information at this point.
So this is like an employment contract, sort of. That's how this works.
Yeah, this is an interview for a job. Basically.
Right. So this gets put out, and then they determine whether or not I get employed. Okay.
Yeah.
It's great. It's great to actually talk about this. It's touching on something that I actively am involved with. Being someone who has always been involved with startups. I raised money before for startups. I've been a part of the negotiations, raising money on the side of the startup, receiving from the VC, and just recently started going through the process of looking into being an accredited investor to invest in startups. And myself having been one, I was quite interested recently that there were some changes that the SEC has made, allowing for a lot more accessibility into startup investing, angel investing. The requirements prior used to be pretty rigid. Ironically, you'd be able to invest in the stock market, right, with $5, anyone who wants to. But for those who do not know, to be an accredited investor, to raise money, as a startup or invest in a startup, you actually have to be an accredited investor. Therefore, the accredited investor regulations used to state that you had to either have one of two or three different qualifications. It was $200,000 per year salary for 2 years with tax statements, I believe, or $1 million worth of net worth, not including your main residence in assets.
Did you have to file paperwork, or was it just you had those assets and you could invest?
So this is tricky. There are paperwork verification services you could use, right? So you could produce pay stubs. You can show pay stubs. You could produce, financial disclosure documents. But there actually is not a official disclosure, an official process unless the company or the fund that you're joining has a request document for you to verify that you are or state that you have been an accredited investor. So a lot of this is tricky because at a time where they might have needed your verification and you did have that net worth, let's say 5-6 years ago, and now you don't, there's not really a time where you would have had to re-verify that. A firm may request pay stubs at the time, and you could show them that you are accredited right now, or you validate to be accredited, but there's not a accreditation. I don't get a blue check mark on my bank account statement, that I get to invest like Twitter. So this is where
wait, I have one question. So let's say I become accredited in 2015, and that's based on my job where I make $500,000 a year, but I lose that job. Do I lose my accreditation?
No, this is exactly that's what I was just touching on, is that since there's no real accreditation service, right, we're not there's no blue check mark, like I said, there isn't somewhere where I have to re-verify that, right? So if I've been making seed, some seed deals, right, and the next company that sees that I've been doing that comes along and doesn't request that I, sign and agree that, I'm signing my life away. If it comes out to be one day that I didn't have that accreditation, I wasn't at the time eligible to invest, and I want to come liquidate my, my position come 5 years later when the company makes $1 billion, if I lied on that document, I'm not going to get the returns, right? It's going to cause a big problem. So I think that's where, the biggest reform really needed to be and wasn't touched on, is that, are you officially still accredited? Do you submit paperwork yearly, to prove that you're still worth that? if you've lost it all, like you can no longer back the company. Wasn't like the idea behind it to make sure you have enough money to fund the company? Like you're not just saying you do.
Right, and bankrupting yourself.
Right, exactly.
Yeah.
So no, if you made that much money net then and you don't anymore and you're not worth that now, there wouldn't necessarily be any anything blocking you. There would be no verification lifted from you unless the firm or company that you're investing in has documentation requesting you to verify at that date that you are still accredited, which would be then it's your word against theirs, right? It's just a honor code kind of system.
All right. So to summarize, previously, to be an accredited investor, you needed a net worth of
$1 million.
$1 million, and then assets.
Including assets,
yeah.
But the trick was that the $1 million has to be $1 million outside of the value of your main residence. So
Okay, not including your house.
correct.
But if you had investment property,
Right,
that would count.
right.
Okay. So then, what are the new rules?
The new rules are crowdfunding for equity. So crowdfunding is usually considered what people associate it with, Kickstarter projects or like GoFundMe. And that's true. That is what crowdfunding's for. But crowdfunding for equity is now a lot more accessible to people because instead of getting a benefit like a 25% off or a free version of the T-shirt, right? Like when you help fund a Kickstarter, you can receive equity in a company. That allows anybody, the same way anybody without an accreditation was able to fund Kickstarter projects, you can fund it for equity, right? Mm-hmm. Now, it used to be that it would be very hard to find these opportunities because it was limited to certain accounts or online platforms such as like Start Engine that had contracts where they'd be your proxy and technically they'd be investing on your behalf, so you were able to. But now they've raised the limit from $1.07 million to $5 million that a company can raise in seed funding via seed crowdfunding. So that's now enough of a seed round, right, size that companies can realistically approach their seed round as a plan and a model to raise money from by the crowd and via crowdfunding, not through traditional venture capital. Problem beforehand was you needed to raise more than $1.07 million. You were, as the company, choosing to block the people you wish you could allow to invest, but you need to raise more money than that. Right now, by raising it, they've made it accessible as deals are happening where companies are raising money. You know what I mean? From the non-accredited investors.
Mm-hmm. So, what do you need to get involved in equity crowdfunding? Like, what are the requirements now?
I would advise if anyone out here to actually look at find online recently Google Sahil and from Gumroad and was it Arlen?
Yeah,
Arlen from Hustle Fund. From
I'll Google it.
Yeah. I can't remember. I don't know if it was part of her fund. That's what I'm trying to get at. Them two together put up a GoFundMe, basically, like a crowdfunding page that allowed for through Republic, which is similar to like a Kickstarter, but instead for equity of companies. A fund. They opened up a crowdsourced fund that was able to raise money from anyone that wanted to invest with, I think, a minimum of $100 or $1,000. And in 12 hours, the $5 million fund, the max size, was raised from not accredited investors. It took 12 hours to be able to source enough people with small checks, right? Anybody person that wanted to invest in companies. And now their fund, right, they're acting as your proxy, is going to invest in companies the same way a venture capital fund does. You're a LP, a limited partner, in a venture capital fund that's investing in these startups.
So Brendan was talking about Arlen Hamilton of Backstage Capital.
Backstage Capital, sorry. Yeah. I often get those confused. But Backstage Capital, by the way, if you're not familiar with it, I would definitely look into it. Arlen Hamilton, she's doing some great work.
Yeah, definitely. That's why I felt bad that I didn't.
Me too. I was like, and I read so much of her, about her too, and Sahil's a phenomenal, innovator in the sense of he's been first on the ball to rolling funds with AngelList. He's first on the ball with allowing the everyday non-accredited investor who wants to get involved in startup investing by more so than raising a fund this way, by doing it when he could have raise the fund on his own, or it's pretty selfless, right? He kind of opening it up to everyone so that everyone knows this is there was half I feel like the purpose, and that's like pretty important for everyone to notice. It's like it wasn't so that this now millionaire already or accredited investor can make a lot of money with these investments. They're allowing anybody to become an LP in this fund of theirs, right?
Yeah.
That way they can go on their behalf fund other companies, right? It's pretty much the opposite of the way people look at venture capitalists, right? You look at them with like this, they're greedy, like, well, if you're crowdfunding the funds to source these deals, you're kind of the hero, no?
Yeah. But in terms of e-commerce, we like Stripe better, so yeah. Just throwing that out there for the record. But Stripe is Gumroad is a great start if you're starting out in e-commerce. Just gonna say that.
Yes, outside of Sahil's work in being an entrepreneur as a startup,
I
his
didn't
investing
say
side,
anyone's name.
his
I said the platform.
his investment, his improvement, his stance on improving the accessibility of startup investing is pretty important. The SEC's rules, as I was touching earlier, that changed.
I was going to ask, why did they change?
This is something that I think is happening all across the board in investing.
I have a theory, but I want to hear yours first.
Yeah. Okay. So if you don't mind, I'd love to hear your theory. To be honest.
All right. So my theory is that like everything's becoming more accessible. Like look at what happened with GME and Robinhood, and the kids were able to dethrone in this situation.
The retail investor was able to get involved with and actually make an impact, and they were able to win.
Hedge funds, right? And so investing is becoming more accessible, and a lot of people have money, in theory, right? And they need more places to put it instead of just the market. Mm-hmm. So they're opening up equity investing. But what are your thoughts?
You're pretty much right on the money. There's a couple extra things there that like situationally happen to all like be a perfect storm. Stimulus checks being one, right? The retail investor has $1,000 in an account of extra money right now to invest, right? So the stock market, the way that the GME Wall Street Bets saga occurred, kind of gave even more than just opening everyone's eyes. It proved that these people, the retail investor, is actually intelligent. There are many of them that knew what they were doing, right? They were not advising you, but in many of their positions, they were taking bets against an exchange, a marketplace, right? They were betting on the fact that there was a worse bet. The short, right, was who they were betting against. Someone has shorted this company. I believe that that's a bad bet. I'm betting against him. I'm not investing in the company necessarily. That's a different form of fundamental, but it's still a fundamental investment, right? So the belief in that, like, there are regular people out there, regular retail investors that with their $1,000 stimulus check they just got, actually do know how to make conscious decisions in the stock market, right? They shouldn't be left out of these investments. So they were allowed to make these crazy investments in public companies for no reason, right? Like where they have no control, but you weren't allowed, that same person, to invest in a company that's trying to get off the ground, right? Like the stimulus, if you think about it, we're trying to give people money so they can help the small business, right? They can go to the store and spend it. It's kind of the same idea. We want to give you money so you can help the small little company get their feet off the ground so that the people that have maybe lost their jobs can start up companies and raise it from the people they know around the corner.
Right, and especially because like when they talked about regulating like retail investing more because people don't know what they're doing with their money in terms of investing, like if you let someone invest in a company, they can't be pulling it in and out, right? So it's more stable that way, in quotes, than investing in the stock market where they could lose it overnight.
Right, and like now, don't get me wrong, it's very, very, you're not always investing. So the rule did state that you have to invest like through a platform, right? Like an online platform. It's not going to be you meeting with the startup. You're going to hand them paperwork, right? You're going to sign documents. There's a line between there, which is, the general partner, the way a venture capital fund would draw capital and fund the startup. There's a platform acting as that proxy on your behalf, right? So let's say Republic is a great one. That's where Arlen and Sahil, where they raised their fund to start this off. You know, that's one example. You're not acting as your own like coach or actual single investor. The same way that you're investing as, you know, you see Sequoia Capital, right, and that funds around. Well, there are limited partners at that fund that put their capital, right, that they have in the fund towards that deal, right? That's how that fund invests. So certain partners receive the benefits when they draw down and they, you know, at future rounds, and they exit and they liquidate. So this is the same kind of idea, right? So for anyone that fears, like, they're like, oh, but why do I have to invest, like, through a platform? Well, like, if you want to be a VC, like, you have to invest through your fund, right? That's right. A very similar process. So online, you would basically be the LP, and Sahil and, for this, you know, instance, Sahil and Arlen are going to be representing you, right? It's your money. They are conscious, very, very wise investors. You want to be the LP in a fund like Sequoia because they're wise investors, right? You feel like they're going to give you a great return. Same idea, except now you can join any, you know, wise investor you believe can turn your money into more money.
Right. And then I would like to say, first of all, Sequoia, if anyone is listening from Sequoia, please fund me. I have ideas, so yeah. Hold on, I'm not done. Okay.
I use Sequoia because it happens to be, I think, the oldest hedge fund in the world, like, that's around. I was just trying to go as far back as I could. There was no name involved in there.
We will be coming to your offices, and I want a meeting. But
I'm not going to show up in sweatpants like Zuckerberg did. That scene in that movie, that's a fact. That is what the reason he did that was at Sequoia's offices, for anyone that doesn't know that.
That is true. But I was going to say, previously, when you go to a hedge fund for capital, you're asking for millions of dollars.
A venture capital fund or a hedge fund? Because it would
Sequoia.
Okay, venture capital fund.
Right. So you're asking them for maybe $3 million at the minimum, right?
Mm-hmm.
But and then they're investors because they get outside money from people like billionaires. Like, right. Name a billionaire.
So like this is like if you want to, okay, it's a little bit different topic, but it's definitely important.
You have to let me finish.
No, yeah,
so you can invest in, like, those companies, but through a venture capital firm. But now you can take $1,000 and invest it for equity in a company.
Right. So, like, if you're not, like, think about who you know that's a partner at a venture capital firm, right? It was the same limitation to be that than it was to be an accredited investor, except so much harder, right? You see, I think Don Valentine, I believe, is the founder of Sequoia, which is, like, I think the oldest. But you see, like, Reid Hoffman, right? Yeah. You'll see his name, partner, Greylock Ventures, right?
Yeah.
He's a partner, meaning he's put his millions of dollars that they require, right? There's a minimum investment into the fund that now Greylock uses as general partner, right? Limited partner, same relationship. And they are the fund that's funding them, right? Now, to join those firms, if you wanted to be able to receive the benefits, like, let's think about it compared to the stock market, right? You expect X return. Let's say you expect a 5% return, right, on something, annually on a certain one of your equities, or 20% is like a great firm, right, might promise you a wealth management firm might promise you 18% returns. Now, it would be awesome for you, right?
Yeah.
Now, that's great. That's stock. That's public investing, right? The way the private market investments would be, you would want to be a Greylock, right? And they fund 100 companies, right? With the billions of dollars that they've raised from outside capital, right? They have raised money from their partners, right? And outside other, like, institutional investors become limited partners of a venture capital firm, and that venture capital firm is now investing in 100 startups. If one or two or three of them hit and become $1 billion company, right? Now the fund has been given and liquidates. They're given $5 billion for their $100 million investment, right?
Yeah.
That $5 billion is given. It's not just the funds, right? It's the people who invested, the limited partners that are funding the fund, are given a 25%, right, return on your money for every X percent of money X percent above our investment that we've earned. So if maybe they make a deal where it's like, for every dollar above break even, 20% goes to the LPs and the rest stays in the fund, right? So You're basically like the stock market. You're expecting a return. You're not just sitting there like the fund going, oh wow, the whole $8 billion, here you go, fund, and it sits in the fund, and then at the end of the year, everyone's just paid millions in bonuses. If you're not the limited partner at that firm that wanted to invest, you and your investors are not going to see that return.
Right, and that just reminded me, like, with standard, like, venture capital and hedge funds, a standard fee structure is 2 and 20. So do you want to explain what that is?
We can get into it like a little bit, but it's mostly about like the 2% is the management fee. So you raise money from let's say like a firm, a fund, a venture capital fund, a hedge fund raises money, right, from limited partners, very very wealthy people who need investment vehicles, right? They want to give you their $100 million because you'll be making smart decisions, and for a living you're going to turn their $100 million into $150 million over 10 years, let's say, right? Okay. That 2% of the 2 and 20 is 2% per year of the amount you invested is charged as a fee for doing the work, right? And then the 20% is 20% of the profits, right, from the deal. Is it the profits, or is it 20% above?
I think
yes, 20% of all of the returns, right? The first 20% above break even of the returns are directly given to the LPs, right? So like you're not, the fund is not going to see any money until its LPs have received 20% return above their investment, and then the rest is the funds. But 2% per year of the amount invested is charged as a fee. So the fund is receiving 2, right? And there's a 20% gain for that 2% fee.
For sure. And yeah, now that you go through a platform, you can cut that out.
Correct. Like you're no longer put in the position where it's, now there are fees, right? I'm sure Republic has a fee, they take a fee, but like you're not stuck in this position where I have to be I mean, I don't know exactly like what each fund needs, but like how do you become a partner at one of these funds, right? Like a VC fund. You have to be a ex-founder of one of these humongous startups, right, that raised billions of dollars. So it's one of two things. It's your impact, your status, right? It's social status basically that gets you a position to be able to be in a fund, or the amount of money you have is at a level of like that, you know what I mean, you need a vehicle larger than the stock market to put your $100 million into, right?
Right.
So you're going to fund venture capitalists to go make their investments and give you that 20% return. You don't get the whole $2 billion when they liquidate. They're giving you they're guaranteeing you a 20% gain, right? Yeah. You will see above that if they kill it for you. Like I can give you one great example of a just like a one investment, like absolute like. Here, I'll just go. Robinhood allowed the retail investor to do what they're doing, right? This new change has allowed the regular everyday retail investor to now get into startups, right? But the thing that gets like kind of lost is like, where does the money actually go? Like VCs, how are they getting their money, right? Like if you make an investment as a fund, who in that fund gets this huge $10 billion when the company IPOs for $100 billion, right?
Right. Also, like, how do they make money on ventures or like companies that aren't very profitable?
Well, so I'll touch on that in a moment. The example I wanted to give was this: like, the reason why they can invest in 100 companies, right, which is their strategy. I'm going to take a risk on 100, right?
Right.
And one's going to pan out, 2, 3. The idea is, I think 3 out of every 100 big ass investments, pardon my language, will hit. And when they hit, they're going to hit big enough that it's going to cover not only the whole fund size that they just invested, but enough to cover gains for every one of their LPs to meet that 20% mark. Now, one example is this. WhatsApp. WhatsApp raised, I believe, $9 million. I have to double check, but I believe it's $9 million from Sequoia Capital in a Series A.
Facebook
okay? Just let me make this clear. Their return when they sold to Facebook was about somewhere in like the $3.6-8 billion range, right? So you had an LP at that fund that put in $4 million, right, to join the fund. The fund was given the access to WhatsApp. You weren't, right? You never had that chance. Their return is, here's your $2 billion. Where are you going to ever see that ever occur, right? That was blocked to the everyday person.
Yeah.
right? Now that can happen to anybody that wants to make an investment in that size, in any size in a company. That was to be able to happen. The whole fund didn't get that money. The LP at that company, at that firm, that at Sequoia, that decided he wants to exercise his, right to put some of his investment money that's in the fund into this startup WhatsApp, right? He saw the drawdown of the returns after the 20%.
Okay. Do partners at the firm, like, I'm an investor in Sequoia. Do I get to say, like, oh, put my money in this company?
So that's what I'm saying is like they're not investors in Sequoia, right? Like those a venture capital firm has partners.
Right.
You have to be invited in. It's a partnership. There's a very large investment amount you must make.
Right.
The company is like built on partners joining together with putting their money, their hundreds of millions of dollars together, right, so that they can sit. And with that $100 million, now they could go. This is bad the way it really works, but like they go to a prime broker and they can now leverage themselves up like 50x to that. And with that $300 million, they now have $600 billion of capital to basically deploy. The reasoning is that a prime broker will give them X percent above. X like 5x, 10x, 15x times whatever their assets are. Well, their assets are $500 million in cash now. So now they have a huge investment vehicle, to start investing with. When that happens, that's the similar, process to when a firm may decide it's going to add a new partner, and that partner is going to bring in a $300 million investment, right? Now, when you see a fund like SoftBank, say they just raised a $200 million round, fund that they're going to deploy. What that means is they went to their partners at their firm, right, the people that work there, and they requested whoever wants to join this new fund we just created internally, right? It's called the Vision 2 or whatever you want to call it. You can now put $5 million, $10 million of your money that they're holding, right? You put it in original investment. You can use your investment money that you have sitting there, deploy it into these certain funds. So I gave you $100 million. This is Fund C. Fund C is what's going to is what we're going to use to make our next 10 investments, right? Fund C is worth $200 million. Do you want to put your $20 million of your $100 million investment into Fund C, right? That's how I would be able to see any returns from anything that's invested in Fund C. So it's not raising money from outside investors. You see what I mean? It used to just be that venture firm. If you weren't a partner at a VC firm, you weren't getting money. The LP was the guy who was getting the money, right? That was the investor. The fund and the LP. You're already $100 million. Like, you're not giving people the opportunity to pool money together, like the masses. The way Wall Street Bets put 2 million people together to make a change, right? Because like-minded people can speak together and can act together. Well, they could do the same to a startup and launch amazing new innovative products, right? Like, we want to get to the moon. Well, right? You hear the race, like, to the moon? Like, imagine if all those Wall Street Bets, if everyone on Wall Street Bets, like 2 million people were like, let's put $2,000, all of us together to a startup, right?
Yeah.
Well, they could do it now, right? And like, that's a lot of money, right? Like, that wasn't possible. You had to listen to hope that the company who was going to make that bet of 100 companies, fund them all, let 90 of you freaking motherfuckers fail. I don't care. Sorry. Like, that's the way they're thinking. You can all fail. We're going to make it because that guy won, right? Like, they don't care that the other 90 that they just gave $100 million to sink down the drain and are all broke now, lost it. Like, you know what I mean? That's not fair. So it matters to be able to be in that position as well, that, you give that accessibility to in the same way that you can invest in a public company.
Okay. So I have a big problem with VCs in general where they fund, like, stupid ideas, right?
Well,
like,
that's the reason. Like I just said. It doesn't matter. They're making a bet of 101.
I know. But so, like, Juicero is a perfect example. Like, that was clearly going to fail. So how...
I have strong opinions on this too, boy.
How do they make money from that? Do they make money at all, or is it just zero?
What valuation did they originally raise the money at?
I can't even remember.
So let's say Series A was like $200 million raise, let's say, right?
Yeah.
And you're valued at $1 billion.
Yeah.
And now you raise another round, and you're valued at $2 million.
Oh, they cash out at the second round.
Oh yeah, right. So like that's what I'm saying is their game is that they don't give anything about you, right? They can make the decision beforehand in secondary markets Like right now, before Robinhood's IPOing, the secondary markets are going crazy. I can tell you for a fact, JC Calcanis is getting. I heard him say in the All In podcast, he's getting offers like crazy for his shares. Right? He's an early investor. You can cash out your shares in the secondary markets to other accredited investors. Right? So now it's worth your shares are worth double. The valuation, they're about to go public at $38 billion, $33 billion. Your shares are valued at when they were $2 billion. Right? Yeah, I'm going to go find someone who's willing to give me the valuation of $20 billion. We'll cut it somewhere in between. And you can take my shares off my hands.
Okay. So, first of all, if you have shares in Stripe and want to sell them to me in the secondary market, let me know.
We just nailed the problem, exactly. Are you accredited? Thank you. So, there's the problem. You used to be able to, even if you were like trying to in the secondary markets to gain shares to these companies, you weren't allowed to hold the share of a private company, you know what I mean, a startup. You had to be able to prove I guess maybe not prove, but you had to be accredited. Now, if there's, let's say, Sequoia, let's say one of these venture capital funds decides to launch its next fund as a crowdsourced fund, I can be a part of a fund that Sequoia invests in companies with, right? Now, I'm basically in the secondary market. That's what I view it as. I view this new ability like a secondary market because it has to occur on a platform, like an online platform, with a proxy, like Republic is. You know what I mean?
So they can sell their secondary shares on Republic, and I can buy them then?
No, right now, that's not like what's occurring. But what I'm trying to say is that like if I own the shares because I was now able to invest in something like on Republic, now I have the ability, like they used to go and sell my shares on a secondary market, right? So like when I see this company double in value, right? Like the old VC used to do, like you just said, how do they make money? I think this company's going to fail, but they're worth double they were when I invested. When our fund invested. I would like to divest out of that at double the price, please, today. I'll take my shares and do that on the secondary market, right? This is where I believe like the next phase of this is, because right now I'm by proxy, right? Republic is acting as my proxy. Republic would have to be willing to sell the shares on the secondary market. So that's where the rules get tricky. It's like you're not really given the full availability like a VC is. There's also a limitation on a certain percentage. You can only invest a certain percentage of your current gross adjusted income per year. So they are monitoring these certain rules, and I don't want to get into too specifics because I don't have any of the documentation in front of me, and it's pretty long and hefty. But it's certainly all designed towards making companies more willing to raise their rounds via crowdsourced funds that will allow funds and or the everyday people to gather together and even consider it, right? Because $5 million is so much more than $1 million as a seed. That many more companies can actually get off the ground. It's now an investment vehicle opportunity, and it's also a strategy that a company can go down.
Okay, so I have two questions. One about Juicero and one about Stripe. So to buy shares of Stripe, someone who owns Stripe shares would have to list them on Republic, and Republic would have to then approve the deal.
So no, like Republic is right now, no. There's secondary market offerings. Republic is not one of them. Republic is a crowdsourced fund opportunity. So my startup can get accepted into Republic and raise funds from you, right? That's what's occurring now. What I'm saying is that Republic, you funded Republic, right? Republic acted as your proxy to me, to my company.
Right.
How do you, right, take your shares if you want to and sell them on a secondary market if Republic is the one who's named on the stock certificate? That's what I was saying. Is I believe next where we get to is like you get even the everyday investor needs to now get more and more rights, right? Like the way that the LP at Sequoia, like we just said, can withdraw his money and have Sequoia, right, sell part of his shares because inside the fund, another one of his partners would be willing to take his shares from him. I can't do that because my name's not listed on it, right? If I do that. Now, I only really care about this because I'm in the opposite sense. Like I'm right now starting in I was about to start a rolling fund, accredited rolling fund. Like just that's 2 weeks ago, I just got it approved into it, and I'm using AngelList Venture, and I really started looking into this is really ridiculous that there's a certain amount of money that a little bit of money that made this possible as of all these opportunities now to invest in, right? And I'm allowed to now create a rolling fund and allows other people to give me money to invest in companies because I have a little bit more money than there's so many people that I know that should be giving me advice, and us all together be doing the exact same thing, right? Like, we all are the same like mind. I'm getting advice from them. They didn't get really lucky and hit it and make a big company once, right? But like, their ideas, if they had the ability to be investing, they would be at the point of being an accredited investor, right? But you blocked them from the opportunity. They knew about it. They knew about Lyft. They knew about Stripe. They knew about, you know what I mean? Like, every one of these companies that eventually are worth billions. You think you and I, would you 2-3 years ago when they were worth $8 billion, would you not have been like, yeah, I would fund Stripe.
Yeah.
If you give me the chance to put $2,000 into the next round of Stripe, I'm in, right? It was obvious. Even when it was at $48 billion, I would have been dying to do so, right?
Yeah.
No one gave me that opportunity. Imagine now if there was a fund like let's say, I don't know what it's called, but the fund that like Sahil and Arlen just had. If they're now able to invest in Stripe right now, right, in the round that they just closed, let's say they had, right, at a $98 billion valuation.
Now we're all investors in Stripe.
Now we're all investors in Stripe because we gave Arlen and Sahil money. There was no system to give Arlen and Sahil money to invest in Stripe for us. It was just Arlen and Sahil were able to invest in Stripe.
Yeah.
Now you see how much more accessible it is. Like, we can do that, but it wasn't like it's there now, right? It's there because, like I said, there's also so much stimulus money that it's possible. Like, there are that many people that just got $1,400. Like, even if you want to say the minimum is $1,000 investment, let alone, you know what I mean? Like, you can make a minimum investment. There's not really like yet a rule I would say that like is pretty easy to get around with, you know, when you want to file for the SEC in this manner, because where you used to not have to really file for accreditation, like I was saying, it's tricky now that they just released this rule. If you want to skirt the few stipulations they did make, which were percentage of your adjusted gross income is what you're allowed to invest in. That's probably going to be more monitored closely, right? Because as they're rolling this out, if it's failing, it's going to be something about people are risking all this money, right? So I wouldn't, say that you can go invest your whole stimulus check. But what I would say is that, like, everyone that just went and put their $1,400 stimulus check into the public stock market would have been able to make way more companies, way more small businesses, like, funded, launch. What if it's a pizza shop on the corner? That's a startup I used to not be able to fund. It doesn't have to be a tech conglomerate.
Especially because, like, when you look at GameStop, they didn't know what to do with all that money.
They didn't touch it. It wasn't GameStop's money. They specifically did not actually, and they've just recently announced, like, that money, if you think about it, think about what the statement of 139% short interest means. It means 139% of 100% of shares are currently shorted. That means all the shares there are to have are owned by people, right? There's no more, there's no liquidity in there. So it means the company itself can't gain money from this. They don't own those shares, right? They have limits. So if Ryan Cohen, came in and sold all of his shares, what do you think that looks like? The guy who just came in as the new chairman is going, oh, well, I'm going to go, you guys are pumping up this stock, I'm going to sell it. It would crash, right? The confidence meter, negative. The guy who comes in, you guys just funded me and I don't believe in this thing, I'm out. No, right? So they hold, right? Obviously. And also, they have lockup periods. They're not allowed to.
Right.
So in order to actually gain any money from this, they would have to have issued a raise, right? A secondary offering.
Right. And
therefore, at a certain price. Which investors, right, institutions of that size, right, of a round in order to raise from the Robin Hoods of the world, like investors, the everyday investors, what price do you think they would have had to fix it in order to get $1 billion in liquidity of cash, right? Like, they would have to justify what. Now the company has to make an announcement and justify and start speaking on what's happening to justify whatever price they targeted at, right? So they would have had to make a statement. Why are you worth $80 a share then, if you believe that you should raise $2 billion in cash at $80 a share? They had made no statements to this whole thing, so they were never in a legal problem of saying it's a pump and dump scheme, it's whatever, right? Their financials don't prove they should be that size company, so they said nothing at all and let the people trade the money, right? And now have a valuation extraordinarily high that says to people, well, look how much money, right, is here available, that if we now, right, decide to exercise on this, right, this many people are paying attention. If we go into e-commerce, if we make these plays that we thought we were going to go do when we tried to recapitalize this company, this many people are going to follow it, right, because they were willing to trade the stock for it. Now that it made them all these millions, You tell me like that which one of these guys that made a lot of money on GameStop is not going right into that GameStop store or buying their games from GameStop as a service, right? Like you want to talk about like customer loyalty? They just gained everything they need, right? What do you think it would have said if they had raised money during this whole crisis? They were like, we're going to capitalize on it while we have a chance and issue this stock offering, and we believe we're worth this much money. Now the SEC is like, why are you worth $180 a share? Because they all said you were, because you guys are doing this whole like scheme, right? That would have looked bad. So they would have had to do it way too low. That now, what's the stock price? If they issue that at $40, they would have killed every one of the retail investors that just got involved.
Right. I think right now it's like at 100 or something like that.
I think it's maybe even higher than that. But like, it doesn't matter about it. Yeah, it matters that like a lot of people were investing in $300, etc. It does, but what really matters is that the company was trading at $5, right? That's when people were starting to, when the rise started. When Ryan Cohen got in, he bought like $8 million, $10 million worth of shares to like go join the board and like retake over this company that was about going bankrupt. Like a week later, the surge. I mean, not a week later, a couple months later, this whole Reddit Wall Street bets happens. Those shares are worth $3 billion, right? Like $3 billion. If he sells them all, that says to everyone, we're not going to make this much money, right? He's not even willing to hold, right? The fact that it's still there, the price is still at what it's at, right? And now they have the ability. What it's saying is like there are some fundamentals that believe that if they now exercise what just happened, is not like it's not a bet that they're like going to be able to win this. It's a bet that like what just happened means that there's this many people interested in actually also being a customer of GameStop. Like they have a business, a legitimate business. They generated $7 billion in revenue last year, right? Like put it into different uses by a different team with this many people, with so much attention on, with how many eyes are on GameStop. And then when they launch whatever the next thing they launch is, you tell me that it's not gonna be a hit. I don't care if it's good or not, right?
Yeah, and actually, really funny story is that while all this is going on, I actually know someone who's working at GameStop, like in their corporate offices, and they weren't prepared for it. They were just like, oh yeah, the stock's going up, but we don't know why.
Exactly, like that, and that's why they haven't made statements until recently. I don't know exactly what they said lately, but like. They had an earnings call. It was their first earnings report since, and they lost. I think they lost a ton of money. But that's not the point. The point is that they made no statements because to make a statement at all would be, I don't know if the right term would be like violation of SEC policy or what it is. But if they were in a lockup period, which we don't know, they wouldn't be able to make any statements. They certainly wouldn't want to say that the valuation of the company is based on fundamentals, right? They would have to announce what's going on. If there was some, like people believe, some weird fishy activity going on, right, where they were pumping it and the insiders were getting out at this valuation, they would have to make a statement.
Right.
Right? Like, by not saying anything, they also didn't play in it, right? Like I said, they didn't gain any money. It was changing hands between you and I. I believe it's worth 200. Well, no, it's worth 220, 240. 260. It was like an auction, right? Just between people, because I know as an investor, 139% short. That means you have a short position. You have to go borrow that share. Well, guess what the price is that you're going to borrow it at? Right. 250 today, right? And in that position, it was an intelligent investment. To say that that's not fundamentally smart, it's not on the books of the revenue of the company fundamentals. It's you made a bad bet, right? You bought a short is to borrow the share at a lower price. You have to physically go get that share at that price. Did you go get it? If you didn't go get it then, you're screwed. That's called a naked short, right? Not legal. So now go get it. Well, if you didn't go get it, you're going to get it at 300, maybe 200. Maybe you have a certain fund that has some at 80 that you can grab, right? Because you need to pay the difference when the expiration of that short, when that short position expires, which was that classic Friday, right? When those all expired and you had your shorts in and you had offering at $12, right? Well, the current price is 300, right? I know I can invest because 139% of the company is short interest. Every single share available, right, is over that, more than that, is shorted. So when this time comes and all these shorts and all these the date expires, Every one of them can't possibly go get all these shorts, can't possibly own a share, right? Like, they said that they went and borrowed it, but it's not possible that they did because there's 39% extra. Where is that sitting? So 39% extra people, we're going to have to go borrow it at today's price, continuously feeding this cycle, right?
Yeah.
It's just, but I know for a fact you can't get it from someone else. Now, if it was under 100% short interest, that means someone has a share that's not shorted, doesn't matter, right? Can sell it to you at whatever price they want, right?
Right.
When it's above that, 100%, it means there's no shares available to be had, right? By an exchange, a brokerage, a market maker has no shares for you. You have to buy it right now at its current price, right? It just feeds the cycle. Right now, with it being short interest under 38%, now you're just making a bet that like it's not it's worth more than whatever their short position actually is. Versus making the bet that once their short expires, I'm betting that I know you have a short, right? It's more like poker. Like, I have 2 aces. There's an ace on the board. You can't have pocket aces, buddy.
Mm-hmm.
It's that game.
For sure. Yeah. That's it. It's a lot to process.
Yeah, I really hope that I correctly stated everything I did in the the discussion about in the private investments. If I did slip up in some of the actual technicals, I don't have any documentation in front of me. I'm speaking mostly about the conversation that needs to be had and it is being had, that accessibility in all fronts is not just giving the opportunity, but respecting the opportunity. Like, these people, the everyday people, do have the right and are good enough, should be trusted, and I believe will help feed the small businesses of the world to I guess take over.
Just because you don't have $1 million doesn't mean you don't know what you're doing with your money.
Right, and what's crazy is what opened my eyes to this was actually being accepted as an accredited investor and in being able to do this. I was like, this is ridiculous. Like 2 weeks ago, like, I was feeling that way. Now I'm not, and it's like such a minimal amount of a difference, right? And like, I don't think that like I gain privilege necessarily because of that like earning or that title, but I believe that the ability to now say I'm going to choose to take my fund and raise it from everyday people, right, and not go to institutions and not go to people with 100 millionaires and only millionaires and accredited investors, and limit, even though it's going to hurt me in some way because my fund can only be up to $5 million, right? Because that's the vehicle size that I can invest with, as you saw Arlen and Sahil. Means I can't make that huge investments in those companies, right? Like I said, that need more than $5 million. But 1 to 5 is a huge jump. There's so many more companies now that needed $3 million. That wasn't a possibility. So now that it is, like, there's just that, it's on both sides, right? Like, startups can raise $2 million and get going, and the people that can fund them can be people like me who want to make small investments in makers, like, you know what I mean? That people I've seen build and like I would trust, like, you know what I mean? That maybe not this $1 billion level, right? But like me and 5 other people who have $20,000 to put together that I can raise from them, and there's $100,000 in brought in, and then the other 2 million or so can come from some more substantial. I'm making sure that like the people who also watched this person build this alongside me, like you, right,
yeah,
will recognize the return, not just me, because like I have a little bit more experience, lifetime, or like I had success. Doesn't mean that you and I right now don't see the same vision in certain company, and we're speaking about a company specifically. We're going to keep it unnamed, but like we both have the same vision. I can currently fund him, he can't. I would rather take my fund and allow it to be raised by him, Alex, to be part of my fund and invest in a vehicle that way, and not have it be accredited investors that gave me money to give it to someone else. It's like, great, so a millionaire made more money. Congratulations.
Yeah, right. Tyler Tringus of Ernest Cap, I remember.
Yeah, shouts to Tyler.
One thing he said was like, a 5-figure check can change someone's life, and that's what we're talking about right now.
Right, like, and it's less than that. Like, Tyler's he's so great, and especially because like his model allows for you to gain your actual equity back and in an earnings share, right? So like he's not trying to like invest in you, like I was saying before, give you $100 million, give $100 million in, and then when you're worth $800 million, he exits and liquidates to another VC firm, and he doesn't care that you didn't make it, right? Eventually you fall on your faces and you're not a company, you're only employed, but they've seen a return. His earning share is like, you're able to pay it back, and then eventually you're just giving him a percentage of your revenue, right? Their firm, for X amount of years until they see whatever that 20% you usually used to, right? So like maybe you make $100,000 a year in revenue, right? And he'll give you like $1 million. Well, until you make $100,000 a year, in 12 years from now, you'll give him $1.2 million, right? That's a way more like he's investing in the fact that you're going to continuously make money, right? Not that in a short period of time his stock might be able to be worth more, that he can exit it. That's all what the other guys are doing, right? He's literally betting that you're going to keep going and you're going to keep getting money and keep making it, because he doesn't keep making money unless you keep making money.
Right. It's not equity. It's revenue, a share of the revenue.
Right. Exactly. Until you repay him. Like, yes, he owns part of the company until you do. But once you're there, like, you're repaying him with your revenue. He's expecting that you're going to, however long it takes you, right? He could be looking at it like it might take you only a year. Of course, this is a great investment, right? But then it can't be possibly given enough equity in the company if the company believes they could pay you back in 1 year. But if the company believes, okay, this is $1 million because I only make $50,000 a year, that's awesome to me. If I make $300,000 a year and someone offers me $1 million investment, I'm like, fine, you can have a couple percent, right? Because I can give that back. I can get that back in a year versus a 30-year loan from a bank, right? That I would have to pay that back. It would be for no equity, right? You would never do that. But if you say to a pizza shop, right, like, here's $1 million, right? You can pay me back as a percentage of your revenue until you give me $1 million too, right? That's awesome, right? And to have someone like that being like leading the way and rising his way through the ranks, to be recognized and earning, like returning, showing a return to his investors, like it's working. You know what I mean? Like it's investing in the idea, the person, most importantly, the person and the belief that you're not going to win if they don't win, right? You can fall on your face. I'm gonna then not get. Now I'm gonna fall on my face. My investors do not get the return. If you make it, I'm gonna keep letting you make it, right? Mm-hmm. That allows me to say, well, you know what? If you need $300,000 more, I see you earning more. I'll give you $300,000 more, and then you're gonna get more you earn more revenue. I see that happening, right? Like I'm in a strategic investment position, right? Like I own equity in your company, and you're making a lot of money. Because now you have $1 million to spend, you could market, right? You didn't realize how much you could make. I'm like, awesome. I don't want to sell my shares back now because now you might go raise a huge venture round, right?
Right.
Like that's available too. So like you can keep them in there because like what if I'm now in the fund, I might want to put in be a part of that $2 million, $5 million, $10 million round, right? That kind of round wasn't going to ever be available to a Tyler in that sense. Now it is because they're able to get into the company and actually believe in them and fund them through the hard time, right? Like when they're struggling and the VC's like, well, I don't really care anymore because like if I liquidate right now, we still killed it. Like, no, he's gonna fight through that part with you, right? Like that to me is like that's where I'm not saying that's where I want to be necessarily like as a fund, maybe it is, but like that's the position I want to be in as a founder, right? Like I want to be raising from people that like want to believe in me, whether or not they actually do, it doesn't even matter, right? It's like the idea, it's confidence, like. You don't want to meet with your VCs, and it's like if you don't show them 10x growth, they don't care at all. Like, it doesn't matter. Like, look how much money we made. Like, I went out and I generated this much revenue, right? Like, it's your fault you told me I need to spend $100 billion. Like, I wanted to raise 10. I walked into your office. You said, no, here's 100, because you'll make 10 times more. Like, right. That's what they tricked you.
And Tyler isn't going to be like, oh, yeah, use this other company I funded for your operations.
The name of it is literally the definition of what you should think of it as, right?
Yeah.
Like, it's literally it's earnest. It's exactly the way it should be.
Right. Because that's what you said happened when you raised money, is that they were like, okay, you need to use this software. They
made, okay, when I raised my first round of capital from a venture fund, it was somewhere like in the $350,000 range or something like that. It wasn't that large, right? But written in the agreement was, I had to use, they charged me, withdrew from that $23,500 to use their internal marketing team's SEO software and data analytics software. Now I'm a data analyst. Like I wasn't programming this. I am a data analyst. Like I built this because I studied enough data, right, to realize what I wanted to build, and I built it off of that market research, right?
Right.
Now I have to pay you $23,500. 6 months in, they still didn't even have a dashboard ready for me, right? Like, you're saying you're stuffing the pockets of a side company that you own, right? I'm not going to name anything in this, but like, That's what it felt like. Now, that's allowed because it's true. The investment company's allowed to say, the firm's allowed to say, we want you to guarantee that you're viewing and making these decisions, right, in a certain manner, and we're going to make sure that you have to use a certain agency. They can stipulate who your prime broker is, who your this is, who your that is, right, like with your shares. It could be part of their agreement. But I think it's ridiculously, like, almost offensive, right, to say, like, you have to pay us for this service. We're going to take it out of the money. And if you can't prove to them that you can have the same service, right? GeckoBoard.com was like $49 at the time. I remember this in 2013. It was just click, add, connect, like Zapier, shouts. I literally, back then, made a Zap that connected my like a Gecko board to my data analytics, my Google Analytics, and I had a dashboard. It was 6 months in, they didn't have a dashboard. It took me $49 in 5 minutes. And I was looking at everything spread out, and I was like, so you're telling me I'm actually paying you $2,000 a month to what? To pay your employees to build this for me? I would build it. I mean, that's not shots at anything about me. I would build it better than them because it's my product. I know what I'm trying to look for. Like,
right, and like SEO, I learned SEO myself through YouTube. I don't need a $1,000
especially
tool.
to be tied to the money that's being given to me. Like,
to grow your business.
Right. Like, that's what I'm saying. That's the logic. That's the proof that they don't care if I'm making enough money and I do that well. They care that, can I be put in a position where in a year or two from now when I re-raise, it's worth more money, right, on paper. Not, did I make enough money? Did I profit? Can I bring home, to my own home, cash? Doesn't matter at all to them, right? That $23,500, I earned $20,000 that year. That my salary was $20,000. I paid those guys $23,500. I never used the dashboard. I don't think I never logged in. I never made a password. By 6 months in, I was like, I think we actually agreed to a separation of it at like 11 because like that was the prorated amount at that point.
And I know Brendan, he literally doesn't remember the name of the service.
I can't tell you the name of it. Still, I looked, and after we spoke about it the first time, I looked it up and I don't think it exists.
Yeah, so check out, I think it's episode 49, interview with Brendan Weinstein. It might be Heisenberg on the podcast website. It was in January of 2020. That was the first time Brendan was on the podcast, and we talked about that a little more. But yeah.
Yeah, that was funny. Like, and it's crazy, right? Because in that year, like, that was me talking about like being funded, like what it's like going through the process of being in like the position of a startup. And like in a matter of a year now, I'm trying to be the guy who's like, not trying to be the guy who's like, but like I would rather be a voice of the ability to be changing the person who invested in me, right? Like that person could have been a different person. I would have made it a lot further. They would have made it a lot further. And I would have been able to get along with because I would have been able to choose and raise from those who are like-minded like me, like you. I would want to raise money from you because you being invested in me, us conversating over, that's not even a word, I hate that I want to say that. Sorry. Over like what the next move should be would be way more important to me. I would listen to it, right?
Right.
If I thought your only interest is like next month, right, when I report earnings, is the valuation going to be high enough, and is there enough liquidity in the company that you can get out? Right. I know that's your view. I'm not going to listen to a word you say. Now, you might be giving me the best advice in the world, but it's like, you know what I mean? A relationship with your customers, just as important, like, it's the same thing as a relationship with your investor. Like, people hate having to, like give VC updates, right? Why? That guy's like, you know how valuable that guy's brain is? That guy or girl? Sorry, I did not mean guy at all. It was in the term, you guys. But like that value is like they're not there as your advisor anymore because you don't trust them.
Yeah, it's weird how much things change in a year. I started this podcast because I was afraid of writing, and now I have a book.
Yeah.
Right.
I raised I raised like a round, and now I guess I'm a accredited investor, and I learned I actually finished this year too a Columbia course in software engineering. That was fun in 2020. So yeah, I've done a lot's changed since, but this is actually the recap of all that would be last year we were online buddies, I guess, like that had met online, and like shouts to MakerLog, like many others I'm sure out you have met through MakerLog, and today like we're sitting here a year and a half later, like in a hotel room, posted up in San Jose, recording this together.
Yeah. All right, but really, before I interviewed him, I didn't really know Brendan that well. And then like the weekend after I interviewed him, we like really started talking for like hours and hours, and we just hit it off like really well. Like, I knew him in September of 2019. We started talking about comedians like Andrew Dice Clay, Bill Burr,
Yeah.
and that's how we started talking.
We still do this shit.
And then we just started talking like every week.
Yeah,
And
no,
it became a thing.
multiple times a day. We were
Yeah.
like, because like it became a point where obviously everyone knows how friendships work like that. But
Yeah.
if you're not like currently involved or actively involved in like an online community, especially during COVID, you know what I mean? Like, I highly suggest it because it's so much different. Like, I think his mother, actually Alex's mother, said something funny like earlier today. He's like, so you're going to meet like a random guy you met online, like, and we were like, it's so not like that because it's like. There's so much commonality between the conversations you've had, and like communities really allow you to like express the person you are, and other people like you will connect with you. You don't have to be this fake person because in person like someone might judge you for it, right?
Yeah.
The first impression is like not there. It's not what you look like and like did you come up looking great at me? It's like, no, did we get along and like laugh at something?
Yeah, and it's really hard to find someone with common interests. Like, okay, I live in the Bay Area, right? And people are obsessed with raising money. And here I am, like, trying to bootstrap myself, do everything myself. I remember I was working at a startup in 2019 when I first met Brendan. And my boss, we were 4 people in one office, about as big as this room. And she was talking about making $4 million so she can raise $4 million annually. So she can raise more money. And I had to bite my tongue and be like, or stop myself from saying, like, you need $4 million more just to raise? Like, if I had $4 million in annual revenue, I'd be on a beach somewhere, like, in Texas, hanging out with my family every day. I wouldn't be in the Bay Area.
You want to know why she has to do that? Because she's beholden to someone who's giving them so much money that they have to give them $8 million back, right? Like, because some VC down the road, back when, said, here's $100 million. I know you wanted 10 and wanted to have a normal little business, but because we have this huge position in your company, we can make your shares worth $10 billion, right? Luring you in. Great, perfect. Now you have $100 million, but you just spent it all. You lost it, right? These companies aren't profitable. You don't have that money at the end of the day, but they got paid.
Right. So the entire time I was there for like 6 weeks, and she was trying to get that first sale. And that was September, and I left in November, like right before Thanksgiving. I don't know if she got those 10 sales before the end of the year. And she was telling me she had a raise in April 2020.
Now, I'll tell you, like, let me...
Hold up. There's more. So, the company was a recruiting events platform. So...
COVID.
Yeah, I think COVID shut the company down.
Now, okay, shut 90, God knows how many companies down, but...
Yeah.
That's brutal. And like, can you imagine the feeling you have inside, right? When you know we were talking about this earlier. Not one person out here could be listening to this, right? We get 0 views. Me and you will be proud of the second we hit end, right?
Yeah.
The second. That is exactly what that person was deprived of. Because she was told that all she did, making all that money, right? Millions. She needs 4 million more, right? Because she can't get 4 million more, she now has nothing. Basically telling her everything you did is worth nothing because you can't make 100 million. Like, that's you get no appreciation for what you can earn, right? Like, the hard work, the success at all is like, yeah, well, that's dinner. So, yeah, I believe that, like, that's just too much, you know what I mean, like, not too much responsibility, it's too much pressure, like, to be in a position where that many millions is, like, determining whether or not the lights go on. Like, what kind of like, millions determines the lights? Like, it pushes back to, like, Tyler's model, right? Like, the model of shared earnings would have never let you get in that position, right? Because the investor's only earning as you're earning. And if they knew that, don't you think they'd give you $4 million more right now if they knew that they can earn more and you can earn more, right? Like, but that's not possible in this current model because you would have to issue a new stock offering, right?
Yeah.
Well, you could just put up a crowd-sized fund offering tomorrow, get your $4 million, and they'll see a return instantly because you'll tell them, hey, if I hit $4 million, I get a fundraise.
Yeah. No, it's ridiculous. And I always say this to Brennan. I say this probably like once a month. It's ridiculous how much money these people are making. Like, you don't need $100 million. You can't spend $100 million.
Now, we had this argument. I can spend $100 million.
You could, but the average person who's financially responsible, shut your mouth, cannot spend $100 million reasonably, let alone $1 billion, dude.
Now, you can, but here's what I'm saying. You can. Why you can. And if you don't know who the person I'm talking about is, you should definitely look into what his philosophies are. Chamath Palihapitiya has an unbelievable vision on his investment strategy. Why do you need $1 billion? I need $1 billion because I only need $50 million, but give me $50 million of that. $950 million of that is so that I can go do something powerful or impact the world, right? Like, I now have the ability to turn $950 million into $10 billion and then put $10 billion into green energy, into climate change, right? If I have the ability, if I'm one of the few people on the planet that actually has the access to that much capital and then can earn that much more, and I'm going to put it towards the right things, I almost feel like it's a responsibility to try to keep earning if that's what the choice you've made, what you're going to invest in, right? Like, if you're going to fund, like, can you actually imagine that, like, all these companies that fail, right? These stupid little apps that are trading, like,
scooters,
literally like scooter apps and or like messaging apps that like let you send emojis, right? Or like you face swaps, deep things. They raise $50 million, $30 million, even I don't care if it's $2. How is every one of those freaking dollars not going to something like decarbonization, right? Like, we know for a fact that the globe is heating, right? Like, global warming is going to force us off this earth. And we are funding applications that allow me and you to somehow get into some problem, right, with like dating apps and like 150 of them, knowing 97 of them are going to fail. When those 97 failed, that much money put towards the right investment. If I'm going to be putting making that choice and funding the right companies, I almost feel like, isn't it a responsibility to like try to earn more money so that I can be putting it into that vehicle? Like, that's what I mean by spending. It's not spending money on things for me. I'm bringing nothing home. By spending, I mean I am going to earn money so that I can spend it on the company that can go, and not investing, literally put it towards the actual cleanup of the ocean, right? Like,
right. No, I don't have a problem with that. What I have a problem with is another dating app.
Right. No, and that's exactly my statement. It's like, I get it that like if you're a part of a fund, like, you don't really have the full say in like whether or not that's what your fund invested in, and like right now they're in the position, like I said, they have to get into every one of them because whichever one hits, like, you can't miss out, right? Deal flow, right. Like, if you listen to VCs or you like listen to this podcast, like they fight tooth and nail to be a part of whichever one they can, right? So that's why they fund every one they can, because it's like, if that one hits, if they become the next $1 billion company, Twitter. Go public through a SPAC, right? Like, this shit's like, I can't even explain how easy, like, it's almost the same way with that prime broker thing I was explaining. It's like, okay, so I have $5 million, I can go to, and now that I'm a fund because I'm accredited, I can go to a prime broker and I have 50x liquidity. Now I have a $250 million fund, right? Like, that's the same thing. It's like, I can reverse IPO via SPAC and have no income, no revenue, pre-revenue. Like, Lucid is a $30 billion company? They have made not $1, right? Like a reservation. You want to reserve a car? Good. It's online. It's free, right? Like, right. It's a placeholder.
Don't get us started on Faraday.
right. Oh. Personally.
No, but see, like, okay, someone born this year can live to 2100. Would it be like 100 years?
Yeah.
So, like, my thing is, why invest in Mars instead of like taking that money and improving the planet for my nephew's grandkids?
I see it a little differently. I don't think it's investing in Mars. I think it's investing in like it's all part of the same. Now, if we can't, it's not like making a bet against. It's almost a hedge. Like, if we can create a way in which, if we have to leave this planet, maybe it's not now. Maybe it's 2900. Right? Like, It doesn't have to be now, but like to only save for the next 100 years, like your grandkids now, you screwed them. Right? Like,
right.
It's both. If you think like the technology needed to get to Mars, right, efficiently and be back and forth, is not meaning we're also figuring out along that way everything that we needed to do along that path to clean it, right? Like, imagine if everything plane that went to Mars sucked up all of the carbonization that in the air while it went through, right? Yeah. And it was like a cleaning vessel, right? Now you're like literally you're helping, but you're still making the statement that eventually, if we could have like pods on Mars, right? That like you exit almost like the space station. You don't go outside like you know what I mean, like because you can't live on Mars. But there's these 100 million square foot vessels, right, that you could be in and almost vacation there, or like if we get to a point where we have to build an establishment where like air from the outside is first cleansed, or like if something happens, right, like the way you could be on a ship. That I know it's not that logical because of what's like where it is and the temperature and everything like that. Like it could be so far away, but the technology that would be needed to get there and do that is so in line still with like where we'd be, down that road that we won't be there unless we can figure out these first 100 years anyway. Is kind of what I'm saying, right? Like,
so you're saying that the technology to get to Mars will help us clean up the Earth?
I think it says a lot, right? Like what if we find things on Mars, like in the rubble, right? Well, that's like teaching us. It's science to save this planet. What if we can learn something about planets that currently can't house people, right? Can't habitat people, that can teach us something about how we can save this planet.
Right. I was just about to say that the technology we create to be able to inhabit Mars could help us
live here.
Yeah,
exactly. That's what I'm saying. Like, if we could figure out how to somehow stand there, we could probably figure out or have gotten to a point, right, where we're near a science level that can figure out some sort of like. Elon Musk is doing this right now, and he's not the only one. And I don't want to
He's not going to be the one to get us to Mars.
That statement can be true, but like.
It very much is.
I'm talking about the decarbonization point, like.
Yeah.
Carbon capture. Imagine if I told you that I could like. Take an airplane vessel and just drive over the Earth. Drive like every airplane. Engines. The back of the engine, right? It spins. The back of the engine is like somehow a device that's like cleaning the air, right? Instead of trying to limit the amount of shit we put up into the air, right? If I told you I can just suck it up and capture it all before it damages us, right? We could at least pause. This is the way I view it, right? We could pause the problem that's going on long enough that we can get to that point that you were just saying, right? Where we've gotten to a scientific point where we can figured it out, right? Like, it gives us that 150 years or something, right? Like, no more damage will be done until we can figure it out. Okay, cool, right? Like, that's an interesting project that I'm thinking about. Like, I would love to be getting, like, I want to start investing in. Like, it's not green. It's like these in another EV company. It's not going to space. Like, those things are awesome, but the idea that like there's a lot of things in smaller sizes that today can make things easier for us to do what we're supposed to do without changing our lives so much. Little things like green. You and I, even as simple as accessibility to investments. The everyday investor is more than likely, and I'm not. This is speaking off of like a mindset, like more my opinion, but I would believe that they're more likely to invest in companies like a private company like carbon capture that's trying to change our climate problem over putting the money in the stock market and making an investment in ExxonMobil.
Yeah, or another dating app because they don't work. Stop creating dating apps.
Should we go into one?
No.
There's one that works, I'll tell you.
No.
Okay.
Don't listen to him.
I got in trouble talking about it once. We're not going to talk about it again.
Right. That wasn't even what... Yeah, that was stupid.
Is this touching record time, huh?
Yeah, definitely. So I still have 2 questions.
Oh, hit me.
All right.
Well, now we're together. Like, kid, don't hit me. Ow. He's hitting me.
Dude, we've been together for like what, 12 hours?
Yeah, no.
And like all our conversations are podcast worthy.
Yeah, no. I said earlier, like, I'm gonna start doing this, like. And that sounded a little bit like, we didn't mean that in a cocky way. We mean it like, genuinely, the things we talk about are things we would want to, even if there's no listeners, like we said before, would be proud, like, are happy with. And like, they're not about nothing, right? They're like, that's what I was saying about what MakerLog did. It doesn't make you connect with people that necessarily, like, are people you're supposed to be friends with, right? Like,
right.
I hate the way this is going to sound, but like, when you see a group of gorgeous girls together or like athletic girls together that are going to the gym or going to a nightclub, right? Like a lot of the people together that are associated with each other are associated by status, figure, wealth, placement, right? Like proximity, looks, proximity. It's not what are you like, what do you do, what are you saying, what are you caring about, right? And I'm just happening to discuss that with you. And through time, we all discuss and like those same things. At your core, you never had to hide and just start going. You want to go to the nightclub, so you went with who went to the nightclub. The people you're going to meet are who's in there. You're limited to that. What if you could say out loud, like, everything you want in that nightclub, and that just surrounded you, right? Like, and that's the nightclub you're in. Like, that's what a community gives you. And then, like, when you meet in person, it's like, did you feel you were meeting me? No. Right? Like, it was like, what up? Like, right?
Like, we hugged each other. We have never met before, and our first interaction was a hug.
Sounds so bad.
Oh my God, shut up. Okay, back to my 2 questions. Oh, also, I want to bring this up. What we're talking about, like, this entire episode has been about how the internet, like, gives you opportunities. Mm-hmm. I just want to put that out.
Yeah, the main, exactly. Like I was saying before, we wish we had recorded everything we were saying today, because it all touches to similar points than this, and that the reason why we're recording this is like, it's not anything about definitely not about me trying to say like the things that I know, which were the statements about what had changed in investing.
I know, he's the
a
worst.
lot of them may not be, like I'm saying, may not be exactly entirely correct, and I don't even really care if they're not. The point is that I want other people to know, if anyone listens to this, that like they should even look into it, right?
Yeah.
Like read into what changes happen. Read in to see if like now you didn't know you could. I'm telling you, there's ways in vehicles now. Like, so if I did, like, I don't know if anyone watches Pardon the Interruption, but at the end of the show, they have an errors and omissions section. If we had that one, I'm sorry. There may be errors and omissions. If I made any, I apologize.
I know of one.
What?
You got wrong about a naked short. You said it was illegal. It's illegal for the
naked shorts are illegal.
Not for hedge funds.
Yes, they're. Yes,
Oh,
it is.
what?
Yes, it is.
So then why are they
yeah,
allowed?
They're not.
So then why do they do them?
Okay, it's technically, this is the way it's considered. A short interest is defined by the amount of the shares and interest, right?
Right.
So you're charged a fee, interest, to borrow that stock, right? So it can be more than 100%. There's only 100% of shares actually outstanding, but including the interest, right? Mm. So they're not allowed to short it naked. They're not allowed to do a naked short, right? But they may have an agreement with another firm that says, in the event you need to, we'll be willing to sell you one on the way down. Right? Is it short? No. I can validly say to you, I have borrowed that share. I have a written agreement, but I didn't spend it yet. Right? It's on contract. Contract trading is fake. It's paper.
Right.
Right? So I have a loan for a prime broker who's given me $50 million, right? That's going to cover my whole short position to purchase it, right? And I know for a fact I can get them back at $80 from him only because we are both partner funds, right? That's what I mean. They're not allowed to naked short, but they could use their fund, right, and their partnerships to go access and get that share that doesn't actually exist at here. A good example is the way that what's his name? Who shorted GameStop really hard?
Andrew left.
No.
Melvin.
Yeah, Melvin Capital. Sorry, Melvin Capital. Gabe Plotkin. So he announced at like a certain. Basically, he was pile drive the hell out of that stock, right? And his short position was the one that caused all this drama. Now his fund was a fund that was basically designed as intentionally shorting companies for the purpose of, finding like fraud and like for the right purposes. Now this short position alone, they lost 53% of the firm's value from that one trade alone, right? Like that happened, but he got out at $90. So if he actually had went and borrowed that share, right? Like he said, and he owned it at $5, right? If he didn't have a deal with somewhere along the lines, another fund, right, to get it back, how did he purchase his shares at $90 before the expiration date if it never hit $90 before the date?
I don't know.
It's still not $90, right? He announced on that Thursday, he announced on Friday, that Thursday night, he was fully out of his short position and closed it out at $90 at a 100% loss.
Right, when
the stock was $200, $300.
And
where was his $90? How did he get it for $90 if it wasn't from another fund or firm?
Right, and especially because when Andrew left, made his announcement that it was worth $20 a share, it was $40.
That's Citron, though.
Yeah,
right?
but I'm saying like
But
when
the fact
all of
that
it
Citron
started,
Research is out of business, they're out of the short interest business. Like, they're out of the shorting business.
Yeah.
What they do for a living is no longer viable in one day. It's worth of trading, right? Like,
Yeah.
it makes a statement. It's like, not all short trading is bad. Like, it could do good things. It could just disclose fraud in many ways. But the way that a hedge fund is allowed to levy itself up and then get such a position in a short interest that is basically, it's not available to the person who's trying to actually go there and make money in the stock market, right? In the average everyday investor, because they don't have a prime broker behind them that can levy them up that way.
Right. So Citron Research, I read their stuff. It's run by Andrew Left, and he made a statement pretty recently, and he said like the reason why I short stuff is to uncover fraud and let the retail investor know like this is wrong. But if the average or the retail investors aren't gonna like, if they're gonna be all Twittery, let's say, I don't know how to put it.
Meme stuff.
Yeah, I'm not gonna do it. And I know Andrew Left from a company called Valiant.
Valiant, yeah.
Yeah, and what they did is they would buy companies.
Yeah.
And they would buy drug companies, and they would
pharmaceutical.
Right.
Like a parent acquisition vehicle for pharmaceutical companies.
Right, and they would have pills that were like available to only 100,000 people needed those pills, and they'd be like $5 pills. Well, Valiant, yeah, that company would buy that company and take that $5 pill and make it $500, right? So that would make the pill inaccessible to the average person that needed it, and that would raise your insurance prices, right? So he said this is wrong, and what they're doing is not sustainable.
Yeah, this is exactly right. This is exactly what I'm saying. Like,
yeah.
This is a short that is, this value is where shorts like should live and should stay, and that's why I don't think we should get rid of them entirely.
This is a great short. Also with Enron, where they were faking their books. That's what.
They were cooking the books, and they were allowed to because there was no Sarbanes-Oxley.
I can explain it.
Sorry.
So Jim Chanos is famous for doing that. That's what I like about shorting, but also what I like about.
What about Michael Lewis?
Yeah.
He got the whole housing industry correct. Like,
yeah.
He was right. These banks were giving out subprime loans, and the mortgages that were given out were not nearly going to be paid back. The housing industry collapse in 2008 was very predictable.
Right.
A lot of people saw it coming, and he shorted the hell out of that. And the Big Short is the Big Short today because of it. Like,
yeah. I want to mention that Michael Burry.
Michael Burry. I didn't even make my. What did I say? Michael Lewis.
Yeah. He wrote the book.
Right. Yeah.
Michael Burry, the one who uncovered it, he lives here in Saratoga. Like, he lives right by my old dentist.
That's cool.
Yeah. So fun fact, and
he's a smart guy.
Yeah, definitely. He's looking at water.
So is Gabe Plotkin. Melvin Capital may have done.
No one cares. No one cares. I'm cutting you off.
He for a very long time he was a freaking amazing investor, right? And he still is. That position was foolish.
Right. Whatever. No one cares. No one cares about a hedge fund.
That's true.
I totally forgot my point. Yeah, so that's the value in short selling. What I liked about Citron was he would email reports, and it was really funny because he'd say like, "Oh, they're doing this, they're doing that."
This is exactly what I'm saying. They stopped doing. Right? That's hilarious. Like,
yes.
This is all the business.
That's not what was funny. The reports were funny themselves because you'd look at this company, and 3 weeks before the report, they're being praised by MarketWatch, and you're seeing the stock plummet. But also, the Wall Street knows that a Citron report, it takes a while to get to the SEC and like
circulate, to get to the public, like
people
to learn it.
To like actually for the SEC to take action. Valiant, that company's still around under a different name because they haven't gathered enough data.
You have to start an investigation.
Yeah, and I've known Andrew Left for like 5 years, right? So yeah, it'd be really funny because you'd watch the stock tank after being praised, and then Wall Street knows that his shorts take a while, so they buy the stock and then short it from that top position.
Right. And now, that exact statement of what you do, like, that's the reason they got out of the business.
That second half, yeah.
Yes, because they are making a conscious statement that, like, it's no longer right that for them to be allowing people to be gaining in that manner, right? Like, it wasn't the short that information that was bad. It was the, we're going to tell you all this because we know you're going to get it first, and this is the scheme you're running, right? That's the business they got out of. I'm starving.
Yeah, so am I. But,
Our dinner's here.
it is? Where is it?
I think it's been here for like 45 minutes.
All right, let's end this. I still have 2 questions. We haven't gone. I've had them for like an hour. No, we'll do a second one.
I'm down.
Thanks for listening. Have a nice day.
Wait.
Bye.